Cryptocurrency exchange FTX made headlines this week as it went from one of the largest companies in the space to filing for bankruptcy in a matter of days. In this episode, we'll discuss FTX, what happened, past scandals, and share a wealth management perspective. FTX was a cryptocurrency exchange led by 30-year-old Sam Bankman-Fried, also known as SBF. Established in 2019, the exchange allowed users to trade and earn yield on digital currencies. FTX acted as a market maker and a custodian of client money. FTX also had a considerable advertising presence. Well-known celebrities like Super Bowl quarterback Tom Brady, NBA legend Steph Curry, and TV producer Larry David were all paid to appear in FTX advertising. The Miami Heat sold its arena's naming rights to FTX. Major League Baseball struck a 5-year deal to name FTX as its official cryptocurrency exchange. It didn't stop, however, with sports and celebrities. FTX executives are reported to have contributed multiple millions of dollars to political candidates during the 2021 and 2022 election cycle. All this to say, FTX was an influential player in the nascent cryptocurrency industry. So what's happened to cause this juggernaut to fail? Well, they ran out of money. FTX reportedly had just $900 million in liquid assets to cover about $9 billion in liabilities. A liquidity crisis for FTX turned into insolvency. Investors rushed to pull money off the exchange and exit positions, adding to the price collapse of various digital assets and tokens. Unfortunately, what's coming to light is that client funds held in custody at FTX were used by Alameda Research, as a hedge fund business owned by SBF. According to documents filed in bankruptcy court this week, FTX could owe money to more than 1 million creditors. While many digital assets may be self-custodied, many users opt to keep their funds on exchange for the convenience of trading or to manage their holdings centrally. The implosion of FTX is being called crypto's Lehman Brothers moment and is bringing up the specter of the 2002 Enron collapse. Lehman Brothers, as you may recall, was the 4th largest investment bank in the US and had been in business for 158 years before its bankruptcy in 2008. In fact, the phrase "too big to fail" came out of the period that we now call the Great Financial Crisis of 2008 and 9. The Enron scandal was an accounting scandal by Houston-based energy trading company Enron. Shareholders of Enron filed a lawsuit after the company's market cap or value, once over $70 billion, plummeted as the stock price collapsed to zero. Enron's size made it the largest corporate bankruptcy in US history, until the WorldCom scandal the following year. The implosion of these once trusted entities isn't limited to the companies themselves. With FTX, we're seeing collateral damage extending beyond the initial blast radius. There are more than 100 related corporate entities that joined FTX in the bankruptcy filing on Friday. At this point, you may never want anything to do with a cryptocurrency exchange ever again. And that's fine. You certainly don't need to, and for many, that will be the end of the story. In the wake of past large-scale bankruptcies, government regulation and corporate restructuring came out of the ashes. This time around, as before, we expect new scrutiny, disclosures, and rules for the exchanges left standing. I'll leave you with 2 wealth management concepts: diversification and allocation. Diversification we can think of as investing in a variety of asset types, each working for different goals across time. Allocation or position sizing considers an investment's risk attributes relative to the portfolio's overall size. Simply stated, the dose can make either the poison or the remedy. At Vector, we believe that no single asset or investment should make or break a financial plan.